In this tutorial, I want to show you how you can use the PPMT function in Excel to calculate the principal payment in any given period on a loan or investment with a given loan amount, interest rate, and duration. So here we have an example where we have a $5,000 loan with an annualized interest rate of 7% that we want to pay off in 12 months. To find the principal payment in every period, we can do equals PPMT, open parentheses. Now, the first argument is the rate they're going to see in each period. Because it's an annualized interest rate and each period reflects a month, we're going to get the 7 and divide it by 12 to get the rate we're going to see in each period. Comma PER represents period, so what period are we in right now? We're in period 1 or month 1 of this example right here. Comma NPER, so how many periods are in this loan? So this example, there are 12 total periods as we want to pay off the loan in 12 months. So 12. Present value. So what is a loan currently worth? It's worth $5,000, and the last two arguments are optional, as you can tell by them being in brackets. So the function will work without them, but to kind of explain them a bit, a future value. So what future values does the loan have? It defaults to 0, which is relevant in this example, but note you can adjust that if you'd like. And the last argument is type. So do we want the loan to be paid off at the end of the period or the beginning of the period, with the payment defaulting to being at the end of the period? I'm going to close parentheses, and you can see in the first period there is $403.47 that will go towards the principal. We can lock things down and then drag it down to see the principal payment in every single period. And as you can see, the first period is $403, but because the interest becomes an increasingly smaller portion of every single payment, the principal payment by the end goes up to $430.12. And you can check to see if the loan is fully paid off by doing the sum of the principal payments minus the present value of the loan, and there should be 0 unless I made a mistake. No, sorry. This is negative, so it should be plus. I'll just sign it right there. As you can see, it's 0. It's negative because these are cash outflows, so negative $5,000. And the loan amount is $5,000. Note, you can adjust any of your inputs, but you will have to change your range. So we adjust this to be a 10% rate. As you can see, our principal payments adjust accordingly. We can adjust the loan amount. And obviously, we have to pay a lot more in every single period. We can adjust the months to pay off to be 5. As you can see, there's a number of as it would extend beyond 5 or 15, for example, and we have to extend our range to account for the 15 periods. But yeah, that's it. I hope we found this to be helpful. If you did, like, subscribe, comment. Thank you for watching. Have a great day.